Assessing the risk to Canadian banks amidst highest debt levels in the OECD. Canada, known for its stable banking system, finds itself at a crossroads as it grapples with the highest debt levels among its OECD counterparts. While Canada's strong financial institutions have weathered economic storms in the past, the mounting household debt poses a significant risk to the stability of the banking sector. In this article, we will explore the implications of Canada's high debt levels and the potential risks it poses to its banks. The debt dilemma. Canada's household debt has been steadily rising over the past decade, reaching record highs. As of 2021, the debt-to-income ratio in Canada stood at approximately 176%, making it the highest in the OECD. This trend can be attributed to various factors such as low interest rates, relaxed lending standards, and soaring housing prices in major cities like Toronto and Vancouver. The Canadian banking system, renowned for its prudent lending practices and risk management, has helped maintain stability in the face of economic downturns. However, the persistent rise in debt levels raises concerns about the bank's exposure to potential defaults, particularly in a changing economic landscape. Risks to Canadian banks. Vulnerability to economic shocks. A high level of household debt increases the vulnerability of banks to economic shocks. In the event of a downturn, such as a housing market correction or a rise in interest rates, over-leveraged households may struggle to meet their debt obligations, leading to a surge in loan defaults. This, in turn, could put pressure on the bank's balance sheets and profitability. Impact on credit quality. A substantial increase in debt levels raises concerns about the quality of credit. If borrowers face difficulties in servicing their debt, it could result in a rise in non-performing loans, adversely affecting the bank's asset quality. This, coupled with a potential decline in the value of collateral assets like real estate, could impact the overall health of the banking system. Interconnectedness. Canadian banks are interconnected with each other, both domestically and internationally. If one bank faces significant challenges due to high debt levels, it could have a cascading effect on other financial institutions, leading to a systemic risk. This interconnectedness increases the importance of monitoring and mitigating risks associated with rising household debt. Mitigating the risks. Recognizing the potential risks, Canadian regulators have taken steps to mitigate the impact of high household debt on banks. These measures include stricter mortgage stress testing, tighter lending regulations, and the implementation of macroprudential policies. By imposing these safeguards, authorities aim to reduce the vulnerability of banks and enhance the resilience of the overall financial system. Additionally, banks themselves have a crucial role to play in managing these risks. Strengthening risk management frameworks, conducting thorough stress tests, and maintaining sufficient capital buffers can help mitigate potential losses and enhance their ability to withstand adverse economic scenarios. Conclusion. While Canada's banking sector has a robust history of weathering economic challenges, the country's high household debt levels present a formidable risk to its financial stability. The potential consequences of rising debt levels, such as increased defaults, declining credit quality, and interconnected risks, warrant careful attention from regulators, financial institutions, and borrowers themselves. It is imperative that policymakers, lenders, and borrowers work collectively to strike a balance between sustainable debt levels and economic growth. By adopting prudent lending practices, enhancing risk management frameworks, and promoting financial literacy, Canada can navigate this precarious situation and maintain the soundness of its banking system for years to come. Thanks for watching.